The market presents itself as a chaotic but ultimately rational system, a complex machine driven by supply, demand, earnings, and human psychology. Yet the true driving force, the mechanism that dictates market calm, fuels asset bubbles, and inevitably triggers the most violent systemic crises, is a seemingly innocuous trading strategy known as a carry trade. This strategy, born from the simple, insatiable human desire to earn something for nothing, has metastasized from a niche currency tactic into the structural vulnerability of the entire global financial order. The authors, Tim Lee, Jamie Lee, and Kevin Coldiron, in their essential work, The Rise of Carry, pull back the curtain on this hidden force, presenting a grim yet necessary truth. The global economy is locked in a self-reinforcing, inherently unstable cycle of decaying growth and recurring crisis. The book's intellectual power lies in defining this carry regime as the dominant macroeconomic reality of the 21st century. At its core, the carry trade is a simple exchange, borrow cheap, invest expensive, capturing the small, persistent difference, the carry, between the cost of funding and the return of an asset. But this small, steady profit comes with massive, leveraged risk, the potential for a catastrophic, rapid loss when market conditions change. The trade is inherently short volatility. It thrives in the long, predictable periods of market calm, periods of volatility suppression, but collapses violently when fear spikes. This pattern perfectly exploits New Age trading psychology, conditioning traders to believe the consistent, small profits are safe, luring them into ever-increasing leverage addiction. The accessibility of cheap leverage through technology has democratized this addiction, turning the Robin Hood generation into micro-carry traders using margin to buy volatile assets, exposing millions to the same systemic risk once limited to large hedge funds. The structural danger is that the sheer scale of the global carry trade actively suppresses volatility, creating the very illusion of safety it requires to thrive. Central bank policies following the 2008 crisis, massive quantitative easing, QE, and zero interest rates, unintentionally supercharged this effect by providing an endless source of cheap funding. This flood of leveraged capital inflates asset prices across the board, from private equity to ETF dominance, driving asset prices to detach from fundamental economic growth. The authors argue that phenomena like Tesla hype, where valuation is based more on low-risk perception than earnings, and the massive price bubbles in asset classes from private equity to fixed income are, in large part, carry-fueled asset inflation. This process transforms the market into a ticking time bomb. The longer the period of low volatility, the more leveraged the system becomes, and the more violent the inevitable carry crash will be. The authors make a profound, chilling case that stock market volatility, driven by the unwinding of these leveraged positions, actively causes recessions and crises. It is not merely a symptom. The carry regime is a silent tsunami, gathering its destructive force just beneath the surface of apparent calm. To truly grasp the magnitude of the rise of carry, one must move beyond the superficial definition and internalize its pervasive nature. The authors establish that the carry trade is not merely a strategy, but a universal financial principle that dictates returns across all asset classes. It is a persistent, low-risk appearing income collected for bearing a rare, catastrophic tail risk. The conceptual clarity begins with a precise understanding of its mechanics: the funding leg, the asset borrowed at a low cost, and the investment leg, the asset purchased at a higher yield. The positive differential, the carry, is a reward for the inherent risk undertaken. The core reason the carry trade is structurally profitable over time is that it is a mechanism for selling insurance against market movement. The steady income, the carry, is the premium collected from the market for providing this insurance. The loss, the crash, is the claim paid out when a catastrophe occurs. Since catastrophes are, by definition, infrequent, the strategy generates a statistically positive return over a long time series, making it psychologically irresistible to capital-seeking positive returns. This statistical reality, however, is a psychological trap, manifesting the infamous sawtooth return profile of long, gradual, consistent profitability interrupted by a vertical, catastrophic drop. This profile is deeply satisfying to human psychology, rewarding the trader most of the time and encouraging the fatal assumption that the small losses and consistent gains represent the totality of the risk. The authors quickly expand the concept beyond its traditional currency roots. They reveal how fixed income is a carry trade, collecting credit spread carry, how equities are a carry trade, collecting dividends and earnings carry, and how commodities are a carry trade, collecting contango carry. This ubiquity demonstrates that the search for yield is the universal expression of the carry trade. Even the most cautious fire movement investor who seeks a high dividend yield in a low-rate world is implicitly engaging in a carry trade, funding their investment with the opportunity cost of low-yield cash. The problem is not the strategy itself, but the unacknowledged leverage scale at which the market is now running it, a scale made possible by the near-zero cost of funding. The relationship between carry and volatility suppression is the key to the entire thesis. The profitability of the carry trade is highest when volatility is low, as the chance of the position unwinding rapidly is minimal. In the modern era, carry traders, particularly those selling options and volatility futures, actively suppress volatility by supplying the market with crash insurance. This creates a powerful, self-reinforcing feedback loop. Low volatility encourages more carry, and more carry leads to further volatility suppression. This manufactured calm is the source of the market's long, stable expansions, but it simultaneously acts as the pressure cooker building toward the sudden, violent crisis. The market is not stable. It is merely being held down by the weight of leveraged carry positions which, when they break, guarantee a massive systemic failure. The authors make a strong case that the carry trade is fundamentally a mechanism for liquidity provision. Carry traders, by taking leveraged positions, are providing the necessary funding and insurance that greases the wheels of global finance. They are compensated for this service by the persistent carry. However, this service comes with a destructive withdrawal. When a volatility spike occurs, these leveraged traders are first to be forced to liquidate, withdrawing liquidity precisely when the market needs it most. This dual role, provider calm liquidity and source of crash illiquidity, is the structural fault line that makes the carry regime so dangerous and leads to the synchronized, destructive carry crash. The individual investor must understand that the smooth returns of many seemingly safe ETF dominance products are often a blend of true market growth and carry-generated profits, meaning they are implicitly exposed to this volatility-driven fragility. The currency carry trade serves as a perfect, illustrative case study for the entire carry thesis, exposing the systemic fragility it introduces into the global economic structure. Lee, and Koldire meticulously detail how trillions of dollars flowing through this specific mechanism distort national economies and dictate global capital flows, proving that the carry regime is the unseen hand directing macroeconomic forces. The classical trade involves borrowing the funding currency. Historically, low-rate currencies like the Japanese yen or Swiss franc, and buy an investment currency, high-rate currencies like the Australian dollar or certain emerging market currencies. The profit is the interest rate differential, captured continuously while the position is held. Crucially, the risk is the exchange rate movement. A small, sudden appreciation of the funding currency or depreciation of the investment currency can quickly wipe out months or years of accumulated carry, especially when amplified by high leverage addiction. The statistical reality of currency movements means that the carry collected is compensation for this constant threat of adverse exchange rate volatility. The author's analysis of the global role of this trade is profound because currency carry acts as a massive transmission channel for monetary policy and risk appetite. When global risk is perceived as low, a period of high volatility suppression, carry flows aggressively out of the low-rate funding countries and floods the high-rate recipient countries. This sudden inflow of foreign capital causes asset price inflation in the recipient nations, fueling local real estate bubbles and credit booms. This is a liquidity dividend of the carry trade, but it comes with a crippling dependency, making the recipient nation's economy vulnerable to external sentiment. The systemic danger emerges during the synchronized, self-reinforcing unwind, when a global shock, a geopolitical event, an unexpected inflation print, or a banking scare triggers a spike in volatility. Carry traders are forced to deleverage instantly. They rush to sell the high-yielding investment currencies and buy back the low-yielding funding currencies to close their short position. This synchronized selling creates a rapid, dramatic depreciation of the investment currency, further amplifying the losses and accelerating the deleveraging. This creates a liquidity vacuum in the emerging markets, leading to sudden, sharp credit contractions and economic crises, proving the author's argument that financial market volatility actively drives economic cycles rather than passively reflecting them. The severity of events like the Asian financial crisis provides a brutal historical vindication of the currency carry crash thesis. The authors also dissect a monetary policy trap created by the currency carry regime. Low-rate countries are trapped as the world's funding source, unable to raise rates significantly without risking a global carry unwind that would destabilize their own currency and export markets. High-rate countries are trapped by the massive capital inflows, which suppress their exchange rates and fuel asset bubbles. This global interdependence means that monetary policy is no longer purely a national affair. It is a leveraged, globally interconnected mechanism defined by the hunt for carry. The entire system is structurally biased toward low interest rates to keep the carry trade profitable and stable, perpetuating an environment that allows leverage addiction to flourish. The contemporary relevance of the currency carry trade is starkly visible in the speculative fervor around various assets. The individual engaging in the Robinhood generation's model of holding near-zero yield cash while leveraging into volatile, high-return stocks is running a personalized, stock-based currency carry trade. The cash is the funding leg, the volatile stock is the investment leg, and the volatility spike is the risk. The inherent volatility of the investment assets means the psychological reward, small, consistent gains, remains high, masking the tail risk of the leverage crash. This demonstrates that the core systemic macro risk has been perfectly mirrored at the micro retail level. The deep connection between carry, leverage, and credit is the central axis of the book's systemic warning, establishing how the pursuit of yield translates into structural financial fragility. Lee, and Cold Iron argue that the profitability of the carry trade is entirely dependent on its magnified scale, and that scale is achieved through the exponential power of credit and leverage, making every carry trade inherently an exercise in volatility suppression. The intrinsic role of leverage is non-negotiable. Since the differential yield to carry between the funding and investment legs is often small, e.g., 2 to 5% annually, traders must use high, leverage 5x, 10x, or even more through derivatives to generate a commercially viable return. This leverage, however, is the mechanism that turns a small price movement into a catastrophic loss, confirming the trade's inherently short volatility nature. The pursuit of carry is therefore the primary driver of leverage addiction across the global financial system. The transmission of carry into the credit markets is the regime's most dangerous feature. The universal quest for carry drives capital into riskier debt instruments, as investors are willing to accept lower compensation, a narrower spread, for assuming more credit risk. This inflow of capital artificially compresses credit spreads, the difference in yield between a safe treasury bond and a risky corporate or junk bond. This compression of the credit spread is the visible signature of the carry regime in the fixed income market. The narrower the spread, the greater complacency and the larger the embedded carry trade. The suppression of credit costs has profound economic consequences. Cheap credit fuels the current, often artificial, economic expansion. Companies are incentivized to take on more debt for non-productive activities like share buybacks, the corporate carry trade, rather than productive investments like R&D or capital expenditures. Individuals take on more debt for consumption and housing. This credit fuel expansion masks the underlying reality of decaying growth in the real economy. The system appears stable, but it is structurally dependent on continuous inflow of cheap funding and the maintenance of low volatility. The book provides a critical analysis of the reverse carry trade, which played a significant role in the 2008 financial crisis. The famous example of Howie Hubler, who lost billions at Morgan Stanley despite correctly predicting the fall of subprime mortgages, is a powerful illustration. Hubler's correct bearish bet was a negative carry trade, costing money to hold. To finance the trade, he put on a massive compensating positive carry trade, betting on seemingly safer mortgage tranches. When the crisis hit, the safer carry trade collapsed due to rising volatility and correlation, wiping out his profits and demonstrating that leverage addiction and the need to finance negative carry positions can lead to catastrophic losses, even when the underlying market prediction is correct. This is a crucial lesson for anyone engaging in option gambling or complex hedging today. The carry cost of a defensive position can bankrupt you if the market volatility exceeds the financing capacity. Ultimately, the chapter establishes that carry, leverage, and credit are inseparable. The carry regime is a system where the universal search for yield fuels credit creation, suppresses volatility, and leads to the systematic overvaluation of financial assets relative to the actual, sluggish economic growth. This mechanism explains the cyclical pattern of long, boring expansions followed by sudden, violent deleveraging events, the catastrophic, periodic cleansing of excessive carry-fueled leverage. The principles of leverage and carry apply directly to modern ETF dominance and structured products. Leveraged ETFs, 2x or 3x funds, are explicit attempts to amplify the carry of the underlying asset, making them highly susceptible to volatility decay, which is the implicit cost of the leverage addiction. Furthermore, the widespread use of corporate debt for share buybacks is, in effect, a massive corporate-level carry trade. The company borrows cheap debt, the funding leg, and invests in its own stock, the investment leg, boosting earnings per share and maintaining stock prices despite often decaying growth. The intelligent investor must recognize this artificial support as carry-fueled asset inflation and understand a sustained rise in borrowing costs or a sharp spike in volatility will force an immediate unwinding of this corporate carry, leading to synchronized stock market crashes. The safety net is not in the stock price, but in the company's ability to service the debt taken out for the carry trade. The authors move from mechanics to deep analysis, detailing the dimensions of carry and explaining why the strategy has remained profitable over long time periods, despite its inherent risks, a statistical paradox that lures capital into the regime. The core explanation lies in the risk premium collected for bearing the rare but massive tail risk. The dimensions of carry extend beyond simple interest rate differentials into systematic risk factors. The book systematically categorizes carry by risk factors. Term structure carry, profiting from the difference between short-term and long-term interest rates. Credit carry, profiting from the credit spread between risky and risk-free debt. Volatility carry, profiting from the difference between realized and implied volatility, typically by selling options or volatility futures. And equity carry, profiting from dividends or buybacks, often using margin to finance the trade. The crucial insight of the book is that positive returns to carry over time are directly related to market volatility, or rather, the market's aversion to volatility. Carry is profitable because it is fundamentally a strategy that sells insurance against catastrophe, the steady profits of the premiums collected for bearing the tail risk of the carry crash. Statistically large, sudden volatility spikes are rare. Therefore, the long stretches of low volatility allow the carry trader to collect premiums consistently, resulting in a statistically positive expected return, which attracts ever more capital into the regime. However, this profitability is not without a heavy, periodic cost, as the returns to carry exhibit a high degree of negative skewness and excess kurtosis. Negative skewness means that the infrequent losses are much larger than the average gain, the financial term for tail risk. Excess kurtosis means that extreme outcomes, the crashes, happen far more frequently than predicted by a normal distribution, demonstrating the statistical danger of the fat tail phenomenon. The carry trade is profitable precisely because these two statistical phenomena exist and persist, with the market continually underestimating the frequency and severity of extreme events, allowing carry traders to collect inflated insurance premiums during long, calm periods. The authors warn that this return profile is the exact opposite of what most individual investors, particularly those in FIRE movement, desire, as a single-period catastrophic loss can wipe out a decade's worth of gains, making a high average return dangerously misleading. This realization is the book's core warning. The apparent profitability of carry is the ultimate trap, luring in capital by appearing low risk for long periods, masking the systemic tail risk. This systemic risk is exacerbated by central bank policies that have aggressively suppressed interest rates and volatility, effectively supercharging the profitability of carry by lowering the funding costs and increasing the period of market calm between crashes. The central banks, in their attempt to stabilize the economy, have inadvertently amplified the very mechanism that leads to recurring crises. The final dimension is the connection between carry and liquidity provision. Carry traders, by taking leveraged positions, provide necessary liquidity to the market. For instance, an option seller provides the option buyer with liquidity insurance in exchange for the premium carry. When the carry trade unwinds, these traders are forced to withdraw liquidity rapidly to cover their leverage losses. turning the market illiquid precisely when liquidity is needed most. This dual role, provider during calm, withdrawer during panic, is the source of the system's structural instability and the severity of the subsequent carry crashes. The pursuit of high dividend yields or high interest returns in today's low-rate environment is a contemporary manifestation of the carry trap. When passive investing strategies blindly chase yield, they are implicitly overallocating to carry trades, e.g., high-yield corporate bond ETFs or REITs with aggressive payouts. The author's analysis should compel the intelligent investor to view yield not as a reward for safety, but as compensation for bearing negative skewness risk. The simple lesson for the Robinhood generation is that the smooth, persistent returns they observe on many leveraged assets are actually the ticking clock on a future, inevitable crash. A truly intelligent investor hedges against this structural risk, perhaps by strategically allocating a small portion of their portfolio to assets that thrive in high volatility environments, convex strategies, or by simply maintaining a large cash position, which is the ultimate anti-carry, short volatility asset. The carry regime is massive and global, but it is executed by specific agents of carry, whose structural roles and incentives perpetuate the cycle of asset inflation and crisis. Lee, and Coldiron conduct a sociological dissection of these agents, explaining how their motivations and regulatory structures contribute to the system's structural fragility. Hedge funds and proprietary trading desks are most explicit and sophisticated carry traders, utilizing high leverage addiction in currency, fixed income, and volatility markets. Their goal is clear: maximize the statistical positive carry return, understanding and managing the associated tail risk. But their risk management often involves complex, opaque hedging strategies that fail when correlation spikes during a crash. Their massive size and synchronized exposure mean their unwinding poses the single greatest systemic risk. Banks and financial institutions are foundational carry agents, using leverage to arbitrage the term structure, borrowing short-term deposits and lending long-term mortgages, and credit risk, holding riskier corporate debt than their funding base. The inherent banking model remains a massive carry trade, and any prolonged low-rate period incentivizes banks to take on more credit risk to maintain profitability, fueling the cycle. Endowments, pension funds, and sovereign wealth funds become involuntary agents of carry due to mandate to achieve high, fixed returns, e.g. 7 to 8% targets. In the low-rate environment, meeting these targets is impossible without taking on implicit or explicit carry trades, often through complex strategies like selling out-of-the-money options or investing in high-yield illiquid assets. This is the institutionalization of the carry regime, where even retirement savings are exposed to crash risk. Individual retail traders have become a mass agent of carry through zero-commission trading and the democratization of leverage. The Robinhood generation engages in micro-carry through the use of margin or simple leverage products, with strategies promoted by financial TikTok and YouTube gurus, such as covered calls for steady income or borrowing to buy high-dividend stocks, acting as classic, explicit carry trades. The psychological draw of small, consistent profits is irresistible, but the aggregate size of these unhedged micro-carry trades contributes to the structural volatility suppression and the eventual synchronized crash. The core incentive problem is asymmetric compensation. Traders are rewarded with massive bonuses for the profitable, stable periods of carry, but are rarely penalized sufficiently for the infrequent, catastrophic losses. This moral hazard ensures that leverage addiction persists as the trader maximizes their personal return during the long expansion, knowing that the carry crash will be borne by the institution or the taxpayer. This flawed structure is a human engine that perpetually restarts the carry cycle. The institutional agents also engage in volatility selling, the most explicit carry trade, to boost their reported returns. By selling insurance against market crashes, they suppress the VIX, further encouraging the entire market to believe that volatility suppression is permanent. This activity is the core mechanism that makes the expansions long and boring, as volatility is constantly being sold into, but it builds the pressure that is violently released during the crash. The ubiquity of financial TikTok and YouTube gurus promoting strategies like covered calls or using simple leverage to boost returns is essentially the democratization of the carry trap. A covered call strategy, while seemingly conservative, is a form of volatility selling, a classic, Carry trade, where the investor collects small, persistent premiums to carry in exchange for capping their upside and bearing the tail risk of a sharp drop that is magnified by the trade structure. The intelligent investor must apply the author's framework to analyze these income-boosting strategies. If a strategy delivers small, persistent profits and involves shorting market movement, it is a carry trade, and its true risk is defined by its exposure to the inevitable volatility spike, not by its historical average return. The carry regime is the author's ultimate conceptual framework, defining the new financial order as a system locked into an unstable equilibrium. Long periods of apparent calm punctuated by violent, necessary deleveraging. The fundamental nature of the regime is its dualistic, self-reinforcing dynamic. It requires volatility suppression to thrive, and by its massive scale, selling crash insurance, it actively contributes to that suppression. The regime dictates a continuous compression of all risk premiums, term structure spreads, credit spreads, and volatility premiums. This compression is a market signal that risk is being mispriced, and it is a signature of the regime's growing fragility. The authors redefine the business cycle as a carry cycle. The expansion is a long, quiet period where carry trades generate profits, fueling credit growth and asset inflation. The corporate carry trade using cheap debt for buybacks. This expansion is characterized by decaying growth because capital is diverted from productive investment to financial engineering. The economic fragility builds not from overproduction, but from over-leverage and asset price detachment from fundamental value. The system is structurally dependent on a continuous supply of cheap funding. The carry crash is the regime's inevitable cleansing mechanism. A volatility spike triggers a deleveraging, forcing the synchronized, leveraged unwinding of carry trades across all asset classes, destroying capital and pulling liquidity out of the financial system instantaneously. The key is synchronization. The crash is global and indiscriminate because carry traders across different markets are betting on the same low volatility environment. This is why the crisis is so systemic, proving that financial market volatility and asset prices actively cause recessions by destroying the leveraged capital base of the economy. The authors connect the regime to global wealth inequality. The process of asset inflation, fueled by cheap carry funding, systematically benefits those who already own assets, the wealthy, at the expense of those who primarily hold cash or labor income. The wealthy, as the primary agents of carry, see their assets inflate disproportionately to real economic growth. The working class experiences stagnation and is locked out of the asset inflation cycle. The carry regime is therefore not just an economic phenomenon, but a sociological driver of inequality and political tension. The final, chilling conclusion is the regime's persistence. The fundamental profitability of the carry trade, selling insurance against rare events, ensures that immediately following a crash, fresh capital will be lured back into trade, guaranteed by central bank policies that suppress rates and volatility to prevent economic collapse. This creates the unstable equilibrium, a perpetual cycle of boom, bubble, and violent crisis. The framework provides a grim prognosis. Without fundamental reform to the monetary and regulatory system, the cycle of decaying growth and recurring crisis will continue indefinitely. The only rational response for the intelligent investor is to recognize this reality and structure their portfolio to be anti-carry. The rise of passive versus active investing is fundamentally shaped by the carry regime. Passive investing, by holding broad market indices, benefits tremendously from the long, calm, carry-fueled expansions. The steady, positive returns generated during these periods make passive investing seem infallibly safe. However, the author's work reveals that this safety is an illusion provided by the temporary suppression of volatility. When the carry crash arrives, passive investors, due to their systematic exposure to the entire market's leverage carry, suffer a synchronized, violent deleveraging. The modern investor must therefore use an active strategy, not to outperform a market during the expansion, but to outsurvive a market during the crash. This involves reducing exposure when volatility hits extreme lows, signaling peak carry, and holding assets that are negatively correlated with carry unwind, convex strategies, or cash. The focus shifts from maximizing return during the good times to minimizing loss during the inevitable bad times. If Tim Lee, Jamie Lee, and Kevin Coldiron were providing an updated assessment of the post-2020 financial world, their analysis would not change the core thesis, but they would identify how new technologies and policies have accelerated the carry regime's dominance and dangers, turning a systemic risk into a nearly inescapable macro force. The authors would immediately identify central bank QE and zero-rate policies following the pandemic as the most aggressive volatility suppression action in history, providing the ultimate, cheap funding leg for the global carry trade and ensuring the decaying growth economy continues to rely on financial engineering. This policy artificially lowered the risk premium to near zero, encouraging unparalleled leverage addiction, which directly enabled the extreme asset inflation witnessed in meme stock manipulation and crypto hype cycles. AI-driven hedge funds and algorithmic trading are viewed not as competitors to carry, but as the regime's optimal, ruthless agents, specializing in harvesting minute volatility carried with high speed and volume, keeping the VIX artificially low. The danger is that their reliance on similar models and data sources means their risk management is highly synchronized, meaning the next carry crash will be characterized by a simultaneous, algorithmic deleveraging across markets, a flash crash that is far faster and more damaging than previous human-driven crises. The phenomena of meme stock manipulation and crypto hype cycles are textbook examples of carry-fueled asset inflation and synchronized human behavior. The low cost of funding and the psychological pull of FOMO culture drives the Robinhood generation to use margin, explicit carry leverage, to buy assets with high return potential but no fundamental value. The volatility in Bitcoin bubbles is a measure of the extreme risk being taken. Yet the persistence of the price is partly supported by the vast amount of leveraged capital-seeking carry returns. The NFT madness is the most abstract carry trade of all, a leverage bet on a cultural narrative, sustained only by the belief that the low cost of funding the trade is worth the high risk of the narrative collapsing. The corporate carry trade remains the structural vulnerability in the equity market. The pressure from index funds dominating global wealth and ETF dominance compels corporate management to continue borrowing cheaply to fund share buybacks, which artificially inflates earnings per share. This process ensures the stock remains highly valued, but also means the equity market stability is built on a massive, leveraged credit carry. A sustained spike in borrowing costs would force these companies to stop buybacks, or worse, struggle with debt service, leading to a profound, synchronized equity crash. The wealth disparity is a direct, sociological consequence of the carry regime. The process of asset inflation, fueled by cheap carry funding, systematically benefits those who already own assets, the wealthy, at the expense of those who primarily hold cash or labor income. This redistribution of wealth, by inflating asset prices disproportionately to real economic growth, contributes significantly to social and political tension. The authors would offer a stark comparison between traditional ideas and the carry regime's reality, dollar cost averaging DCA. While a sound strategy, its high returns in the last decade were artificially boosted by the carry regime, and the investor must acknowledge this and maintain a disciplined focus on decaying growth rather than assuming a rapid return to pre-crash growth rates. The day trading psychology in the 2020s is simply a faster, riskier form of the carry trade, with a pursuit of small, consistent daily gains through strategies like scalping or using small leverage works on calm days, but is mathematically guaranteed to fail violently when volatility spikes, as the high frequency of the trades maximizes exposure to the liquidity trap of the crash. The prevalence of financial TikTok and YouTube gurus promoting steady income strategies using option gambling, selling volatility, is a democratization of the carry trap, generating small, consistent fees to carry in exchange for exposing their followers to the unhedged, catastrophic tail risk. The author's ultimate warning is that the decaying growth continues to worsen because capital remains trapped in financial arbitrage, and the only rational response is to structure portfolio to be anti-carry. The conclusion of the rise of carry is not an ending, but a critical awakening. The journey has illuminated the forces of leverage, volatility suppression, and systemic risk that define the modern market, proving that the carry trade is a hidden gravity, pulling all assets into an unsustainable equilibrium and guaranteeing the cycle-long, deceptive calm followed by violent, synchronized crisis. The book's ultimate purpose is to equip the investor with the foundational knowledge to anticipate and survive the carry crash, compelling the primary goal to shift from maximizing return during the expansion to maximizing survival during the crash. The 10 timeless principles distilled from the book serve as the ultimate survival guide. The carry warning sign treating small, persistent profits as compensation for negative skewness, long volatility as your hedge, allocating capital to thrive during a volatility spike. The essential counter-trade to the global short volatility regime. Liquidity is anti-carry, maintaining substantial cash reserves as the ultimate hedge. Analyze the credit spread, monitoring credit spreads as the signature of peak complacency and inadequate risk premium. Examine the corporate balance sheet. Scrutinizing companies relying on cheap debt for share buybacks. Decouple from synchronization, holding assets that are negatively correlated with the carry unwind. Identify funding currencies, recognizing that low-rate regions provide the most dangerous trigger for systemic carry crash. Reject inadequate compensation, refusing assets with returns barely above the risk-free rate. The time lag. Trap, using patience to remain defensive when the market is euphoric. And structure for survival, focusing on out-surviving the market to seize the deep opportunity created by the deleveraging. These principles demand long-term thinking, profound skepticism, and the emotional discipline to reject the psychologically addictive profits of the carry trade, ensuring the intelligent investor is the one who survives the destructive end of the cycle. The financial market, viewed by the untrained eye, appears to be an impenetrable storm of complex, competing forces. Yet the authors, Tim Lee, Jamie Lee, and Kevin Coldiron, reveal that this chaos is orchestrated by a singular, seductive, and structurally dangerous mechanism, the carry trade. This strategy, a simple transaction of borrowing cheap to invest expensive, has transitioned from a niche arbitrage tactic to the global gravitational force dictating asset inflation, credit cycles, and inevitable systemic crises. In their authoritative work, The Rise of Carry, The Dangerous Consequences of Volatility Suppression, and the New Financial Order, Decaying Growth, and Recurring Crisis, the authors lay bare the anatomy of this carry regime, presenting a necessary, if chilling, truth. The prolonged periods of stability and rising asset prices we have experienced are not signs of economic health, but rather the visible pressure cooker building toward a violent, synchronized collapse, locking the world into a pattern of decaying growth and recurring crisis. The ideological core of the carry trade is the exploitation of human behavioral weakness and the structural flaw in financial systems. It is inherently short volatility, meaning the trade prospers in periods of predictability and calm, delivering a seemingly guaranteed incremental profit, the carry itself. This return profile, characterized by its slow, steady upward march known as the sawtooth return profile, is psychologically addictive. It rewards the trader 99% of the time, conditioning both the individual investor and the largest hedge fund to believe that the negligible daily losses represent the entirety of the risk, driving a relentless escalation of leverage addiction. The accessibility provided by cheap leverage through technology has transformed the Robinhood generation into a vast army of micro-carry traders, using margin to amplify returns on volatile assets, inadvertently participating in the same systemic short volatility bet once reserved for institutional desks. The structural threat intensifies because the massive scale of these leverage carry trades actively suppresses volatility, creating the very illusion of safety it needs to thrive. Post-2008 central bank policies, specifically quantitative easing QE and zero interest rates, acted as the ultimate accelerant, providing an endless, cheap funding leg for the global carry trade. This deliberate suppression of the cost of funding and the fear index VIX artificially inflated asset prices across the spectrum, from ETF dominance to private equity, disconnecting them from the sluggish reality of decaying growth. The authors argue persuasively that much of the asset inflation seen in phenomena like Tesla hype is not a function of exceptional productivity, but the aggressive capital flow seeking carry in a low-rate, low-volatility world. This systemic fragility means a market is not fundamentally stable. It is merely heavily leveraged, and the collapse, the carry crash, will be a synchronized event driven by the instantaneous withdrawal of leveraged capital, proving the author's thesis that stock market volatility actively causes recessions rather than just reflecting them. This framework is the essential lens for understanding the systemic vulnerability of the global financial order. The deep conceptual integrity of the rise of carry requires a rigorous, almost philosophical deconstruction of its mechanics. The authors posit that the carry trade is an expression of the market's continuous, leveraged search for a positive return on capital, defined by the systematic harvest of small, persistent yield differential. The strategic elegance of the trade is derived from its exchange a high probability of a small gain for a low probability of a massive, synchronized loss. This statistical trade-off is why it attracts trillions in capital. The persistent low volatility periods allow the trader to accumulate substantial profits, which are, in effect, the insurance premiums collected for bearing the tail risk of the crisis. The statistical profitability of this insurance selling lures fresh capital back into the regime after every crash, ensuring the cycle's perennial nature. Lee, and Cold Iron meticulously expand the concept of carry beyond the traditional currency arbitrage. They classify the trade into various dimensions, including term structure carry, profiting from the slope of the yield curve, credit carry, profiting from the credit spread, and volatility carry, profiting from the difference between implied and realized volatility, often by selling options. This ubiquity demonstrates that the carry regime is a universal default strategy when funding costs are suppressed. Even a conservative fire movement investor seeking a high-yield corporate bond ETF is running a credit carry trade, implicitly funding their purchase with a near-zero return of cash. The statistical reality that makes this palatable is the negative skewness of the returns, a large number of small gains followed by a rare, but devastating, loss that falls far outside the expected mean. This profile violates the assumptions of nearly all traditional risk models, making the standard deviation volatility an utterly misleading measure of the strategy's true danger. The authors delve into the historical precedent of the carry trade's systemic consequences, emphasizing that this is not a new phenomenon, but one amplified by modern finance. The long-term capital management LTCM crisis in 1998 serves as a textbook example of a leveraged credit carry crash. LTCM strategy involved highly leveraged bets on the convergence of various bond spreads, a complex carry trade. When the unexpected Russian default caused spreads to widen violently, the leveraged positions immediately unwound, creating billions in losses that threatened the solvency of major counterparties. This event proved that the unwinding of leveraged carry trades is a systemic liquidity event, capable of triggering global financial collapse, a lesson that should have served as a permanent warning against leverage addiction. Crucially, the authors established the carry regime's functional impact on liquidity. Carry traders, by taking leveraged positions, provide necessary liquidity to the market in calm periods. They are the buyers of last resort and the sellers of crash insurance. However, when the volatility spike, the carry crash, occurs, these same traders are forced to liquidate instantly to meet margin calls, leading to a massive, synchronized withdrawal of liquidity across all markets. This transformation from liquidity provider to liquidity vacuum is the core instability of the system, turning a market correction into a self-feeding, destructive crisis. The intelligent investor must recognize this dual nature, understanding that market calm is merely the period during which systemic fragility is being secretly built up through excessive leverage. The currency carry trade provides the most elegant and macroeconomically potent illustration of the carry mechanism. Lee, and Cold Iron detail how this specific trade, rooted in the arbitrage of interest rate differentials between two national currencies, acts as a multi-trillion-dollar transmission belt for global capital flows, inevitably subjecting recipient nations to the whims of global risk appetite and systemic volatility. The mechanical simplicity, borrowing the funding currency, low interest rate, and buying the investment currency, high interest rate, belies its catastrophic risk. The profit relies on the assumption of exchange rate stability, a bet that is statistically profitable most of the time, but carries the tail risk of sudden, sharp reversal that wipes out the leverage position. The book's analysis of the trade's macro impact is crucial for understanding decaying growth and recurring crisis. When the carry trade is on low global volatility, massive amount of capital flow out of funding currencies like the yen or franc and flood high-yield emerging markets like Brazil or Turkey. This sudden, leveraged influx of foreign capital artificially inflates asset prices, real estate, local stocks, and lowers domestic borrowing costs in the recipient nations. This creates a carry-fuel credit boom that sustains the economic expansion, but masks underlying structural weaknesses. The local boom is fundamentally dependent on the continuation of low global risk perception. The carry crash in the currency market is the most violent demonstration of the regime's systemic flaw. When a global shock occurs, signaling a risk-off environment, carry traders across the globe rush to unwind their leveraged positions simultaneously. They sell the high-yielding currencies, causing a rapid, dramatic depreciation, and buy back the low-yielding funding currencies, often leading to a sudden spike in the yen or franc. This synchronized leveraging creates a massive, instantaneous liquidity vacuum in the emerging markets, leading to sharp currency devaluations, sovereign debt crises, and severe economic contractions. The 1997 Asian financial crisis, with a sudden, leveraged withdrawal of foreign capital from Thailand, Indonesia, and South Korea, triggered a contagion of currency collapse and banking failure, serves as a defining historical validation of the currency carry crash thesis. The crisis was not caused by fundamental economic collapse. It was triggered by the systemic unwinding of financial leverage. Furthermore, the authors explore the global monetary policy trap created by this regime. Central banks in low-rate countries, the funding sources, are effectively held hostage by the global carry trade. Raising their rates significantly risks triggering a massive, destabilizing carry unwind across the entire system. Central banks in high-rate countries, the recipients, are trapped by the massive capital inflows, which can lead to overheating and asset bubbles. This global financial interdependence means that the carry regime exerts an enormous, structural bias toward low global interest rates to maintain its profitability, ensuring that leverage addiction remains a default position for capital worldwide. The intelligent investor must recognize that the stability of their retirement funds is now structurally linked to the ability of the Japanese central bank to keep its rates suppressed. The application to the modern retail environment is clear. The individual utilizing zero-commission trading and margin to buy high-yield stock is running a stock-based currency carry trade. Their cash is the funding currency. The stock is the investment currency. They are implicitly betting that the volatility of the stock price will not exceed the margin capacity, a short volatility bet identical in statistical profile to the macro currency trade. The Robinhood generation's adoption of this leveraged micro-carry trade contributes to the structural fragility, amplifying the severity of their personal losses when the macro carry crash forces a synchronized market deleveraging. The connection between carry, leverage, and credit is a mechanism by which the carry regime translates a statistical opportunity into a systemic threat. Lee, and Goldine argue that every single carry trade, by its very nature, is an act of credit and leverage, and that the universal pursuit of carry is the primary driver of credit expansion and the subsequent compression of risk premiums throughout the global economy. The use of leverage is mandatory because the yield differential, the carry, is typically too small to generate commercially viable returns without amplification. This makes leverage addiction an inherent, structural feature of the regime, not merely a moral failing of individual traders. The authors meticulously track the transmission of carry into the credit markets. The persistent flow of capital-seeking carry drives down the borrowing costs for riskier entities, leading to the sustained compression of credit spreads, the yield difference between safe government debt and riskier corporate debt. This compression is the most reliable, visible fingerprint of the carry regime's fragility. A narrow credit spread signals market complacency, as investors are receiving historically low compensation for bearing high levels of credit risk. This low cost of capital fuels the corporate carry trade. Companies borrow cheaply to fund non-productive activities like share buybacks, boosting EPS and maintaining high stock prices, which mask the underlying decaying growth of the real economy. The historical study of leverage in credit cycles shows that the systemic danger is rooted in the destructiveness of deleveraging. The crisis is triggered not when the underlying economy falters, but when the sudden spike in volatility forces highly leveraged carry positions to unwind. The crisis of long-term capital management, LTCM, in 1998, a highly leveraged carry trade betting on convergence of fixed income spreads, proved this point. When Russia defaulted, spreads widened violently. LTCM's massive leverage positions could not withstand the unexpected volatility, leading to a catastrophic failure that required a Fed-orchestrated bailout to prevent a complete collapse of the global credit system. This event serves as a canonical warning. The size and speed of the loss in a leveraged carry crash are far greater than those predicted by standard risk models. The authors also dissect the peril of the reverse carry trade in complex hedging. When a trader buys a defensive position, like protected put options, that is a negative carry trade, costing money to hold, They are often forced to finance that cost by entering a compensating positive carry trade elsewhere in the portfolio. The tragedy is that during the carry crash, when volatility spikes, the safe positive carry trade collapses simultaneously with the underlying market, wiping out the entire portfolio despite the original correct offensive position. This illustrates the insidious reach of the carry regime, where even attempts at prudence are compromised by the pervasive psychological and financial necessity of chasing yield. This is a structural flaw that affects sophisticated option gambling and hedging strategies today. The key takeaway is that the current economic expansion is fundamentally fragile, built on the assumption that the cost of credit remains suppressed and volatility remains low. The moment these two variables normalize, the leveraged credit structure, the core of the carry regime, will implode. This inevitable deleveraging process is a carry crash, which destroys leveraged capital, causes synchronized asset price collapse, and triggers a subsequent recession. The intelligent investor must recognize that credit growth in this environment is not a sign of economic vigor, but measure of systemic fragility fueled by the universal, leveraged pursuit of carry. The analysis of carry profitability is the book's deep dive into the statistical paradox, why a strategy with such devastating periodic losses remains structurally profitable over the long term. Lee, and Cold Iron reveal that the profit is the quantifiable reward for bearing the negative skewness risk that the market systematically underprices. The authors fully dissect the statistical characteristics of the returns, emphasizing negative skewness and excess kurtosis. Negative skewness confirms that the strategy's infrequent losses are far larger than its frequent small gains. This is a financial definition of tail risk. Excess kurtosis confirms that these extreme events, the carry crash, occur far more frequently than predicted by traditional bell curve risk models like the Sharpe ratio. The profitability of the carry trade persists precisely because the vast majority of market participants, from individual traders to institutional risk managers, use models that fail to capture the high probability of these rare, extreme events. The Sharpe ratio, the most commonly used measure of risk-adjusted return, is particularly misleading for carry trades, as it penalizes volatility but fails to capture the catastrophic nature of the tail risk. The dimensions of carry extend to every systemic risk factor, showing the strategy's ubiquity. Term structure carry, betting on the slope of the yield curve. Credit carry, selling credit insurance. Volatility carry, selling crash insurance. And equity carry, leveraged dividend harvesting. The continuous profitability across all these dimensions confirms the author's thesis that the carry regime is a universal price collected for supplying stability and liquidity to a system that structurally avoids catastrophe risk. The long, stable periods allow carry traders to accumulate substantial premiums, luring ever more capital into the short volatility trade. The danger, however, is that this persistent profitability leads to structural complacency and a systematic compression of the risk premium. The low-rate environment initiated by the central banks has reduced the funding cost, supercharging the incentive for carry. At the same time, the aggressive flow of capital-seeking carry has compressed the returns collected for bearing the tail risk. This creates the most fragile environment. The system is being paid less than ever to take on the same or even greater level of tail risk. The authors argue the market is now in a state of inadequate compensation for massive systemic risk, making the eventual carry crash both statistically inevitable and economically more destructive due to the narrow safety margins. The relationship between carry and liquidity provision is reiterated as the source of the crash's severity. Carry traders are compensated for providing stability, but their leverage positions ensure that when the volatility spikes, they become the primary source of illiquidity. This systemic vulnerability means that a small, unexpected event is instantly amplified by the synchronized rush to deleverage, leading to massive, non-fundamental price movements that turn a simple correction into a profound crisis. The intelligent investor must acknowledge that the market's seemingly smooth operation is a leveraged facade that will collapse instantly when volatility returns. The final insight is the psychological persistence of carry. Despite the devastation of periodic crashes, 1998, 2008, the allure of the small, persistent profit ensures that human memory is short. Capital is quickly lured back into the strategy, guaranteed by central bank policies that suppress rates and volatility to prevent economic collapse. This inherent human and structural bias ensures the carry regime is a self-perpetuating cycle of boom, bubble, and violent crisis. The only rational defense is to consciously structure portfolio to be anti-carry, to be long volatility and short the persistent, yet destructive pursuit of yield. The complexity of the carry regime is best understood through its agents of carry, the institutions and individuals whose motivations, incentives, and structural roles collectively perpetuate the cycle. Lee, and Coldiron conduct a rigorous analysis of these agents, from the esoteric desks of Wall Street to the mobile screens of the Robin Hood generation. Hedge funds and proprietary desks are the system's most sophisticated and concentrated agents. They utilize high-frequency trading and algorithmic models to systematically harvest carry across all dimensions: volatility, currency, and credit. Their massive size and reliance on high leverage addiction mean they are the primary source of both volatility suppression through synchronized option selling and the most significant systemic risk. The authors point out the critical flaw in their risk management: the reliance on statistical models that assume a normal distribution of returns, leading them to dangerously underestimate the tail risk and the likelihood of synchronized failures due to high correlation during a crash. Banks and financial institutions are foundational carry agents, structurally committed to the trade to maturity transformation, borrowing short and lending long. The term structure carry. The post-2008 regulatory environment attempted to curb explicit proprietary carry trading, but the inherent banking model remains a massive, levered carry trade. Banks are incentivized to increase credit risk during low-rate periods to maintain profitability, fueling the credit expansion that defines the benign period of the carry regime. Institutional investors, pension funds, endowments, and sovereign wealth funds become massive and often involuntary agents of carry due to high, non-negotiable return mandates. In a low-rate world, they are forced to engage in implicit carry trades by investing in a liquid, high-yield assets or by selling index options to boost current income. This structural pressure is dangerous because it institutionalizes negative skewness risk within the retirement system, guaranteeing that the carry crash will have a profound, destabilizing impact on the broader economy and political stability. The authors view this as a tragic consequence of the regime. Even the most conservative capital is forced to participate in the systemic fragility. The individual retail trader has, by the millions, become a mass agent of carry. The combination of zero-commission trading and easy access to margin and derivatives has democratized the strategy. Strategies promoted by financial TikTok and YouTube gurus, such as selling covered calls for steady income or borrowing to buy high-dividend stocks, are textbook examples of explicit carry trades. The psychological reward of small, consistent profits is addictive, but the aggregate size of these unhedged micro-carry trades contributes significantly to the overall volatility suppression and exposes the individual to the catastrophic tail risk of a synchronized crash. The individual's exposure is massive, as they lack the capital buffer or sophistication to hedge the negative skewness. The crucial structural flaw identified by the authors is asymmetric compensation and moral hazard. Traders are massively rewarded for the smooth, stable profits generated by carry, but are rarely penalized personally for the infrequent, catastrophic losses that wipe out decades of gains. This incentive structure ensures that leverage addiction persists as the trader maximizes personal wealth during expansion, knowing that the systemic carry crash will be borne by the institution, the taxpayer, or the next generation of investors. This is a human engine that perpetually restarts the carry cycle despite its proven destructiveness. The carry regime is the author's definitive conclusion, a self-perpetuating, structurally unstable new financial order. This chapter synthesizes the principles of carry, leverage, and volatility into a singular, overarching theory of modern financial crises. The fundamental nature of the regime is its dependence on volatility suppression and its inherent tendency to compress all risk premiums to unsustainable levels. The authors redefine the business cycle as a carry cycle. The expansion is a long, quiet period where carry trades generate profits, fueling credit growth and asset inflation, the corporate carry trade. This period is one of decaying growth because capital is diverted from productive, long-term investment towards short-term financial engineering. The fragility is built not by economic fundamentals, but by over-leverage and asset price detachment from those fundamentals. The system becomes dangerously dependent on the perpetual supply of cheap funding. The carry crash is the regime's inevitable violent correction. It is triggered by a sudden spike in volatility that forces the synchronized, leveraged unwinding of carry trades across all asset classes, currency, credit, and equity. This unwinding destroys leveraged capital, causes a massive instantaneous liquidity vacuum, and leads to a synchronized, severe asset price collapse. The key insight is synchronization. The crash is systemic because all carry traders were betting on the same low volatility state. This event is a true trigger for the recession, proving that financial market volatility actively causes economic contraction rather than merely following it. The authors strongly connect the regime to global wealth inequality. The process of asset inflation, fueled by cheap carry funding, systematically transfers wealth from those who hold cash, the working class, to those who own assets and can access leverage, the wealthy. This financialization of the economy at the expense of productive growth is a profound sociological driver of inequality, contributing to political and social tensions observed globally. The carry regime effectively institutionalizes the redistribution of wealth upwards. The ultimate warning is the regime's persistence. The fundamental profitability of the carry trade, selling insurance, ensures that fresh capital is lured back into the strategy after every crisis, guaranteed by central bank policies that suppress rates and volatility to prevent economic collapse. This creates the unstable equilibrium, a perpetual cycle that is statistically guaranteed to repeat. The authors provide a stark prognosis. Without fundamental reform to monetary and regulatory system that controls the cost of funding and the level of leverage, the cycle of decaying growth and recurring crisis will continue indefinitely. The only rational response for the intelligent investor is to recognize this reality and structure their portfolio to be anti-carry. This requires consciously being long volatility, the hedge, and short the systematic pursuit of carry, the structural bet, prioritizing capital preservation and liquidity over the tempting but fatal profits of the carry expansion. The contemporary financial landscape, post-pandemic, serves as the ultimate laboratory for the carry regime. Lee, and Coldine's analysis must be applied to the accelerated technological and political forces that have amplified the regime's scale and fragility. The authors would identify central bank QE and zero-rate policies as providing the necessary massive liquidity to fuel the most extreme carry trades in history, enabling the explosive growth of highly speculative assets. This policy created the environment for meme stock manipulation and extreme valuations in the housing and stock markets, which became the recipients of carry-fueled capital flows. AI-driven hedge funds and algorithmic trading are viewed as the optimal agents of this regime, capable of harvesting volatility carry with high speed. The danger is that their model-based, synchronized trading creates an extreme fragility where the next carry crash will be a flash crash, faster, deeper, and more instantaneous than previous human-driven deleveraging events. The authors will warn that the speed of the algorithmic unwind will severely shorten the time window for human reaction. The phenomena of crypto hype cycles and NFT madness are textbook examples of carry-fueled asset inflation. The low cost of funding and the psychological pull of FOMO culture drives leverage capital into these assets. The Bitcoin bubbles are a measure of the extreme risk being taken, sustained by the hope of the high carry return. The NFT madness is the ultimate leverage bet on a cultural narrative, sustained only by the low cost of funding the trade. The author's thesis is proven by the fact that the volatility in these assets is always higher than traditional assets, yet they continue to attract capital due to the promise of exponential carry returns. The corporate carry trade remains the structural vulnerability in the equity market. The pressure from index funds dominating global wealth and ETF dominance compels corporate management to engage in a carry trade, borrowing cheaply to fund share buybacks. The authors would warn that the stability of the entire passive investing movement is now reliant on continuation of low borrowing costs, making passive investors implicitly the largest funders of the carry regime and exposed to the ultimate synchronized crash. The authors would offer a stark comparison between traditional ideas and the carry regime's reality. Dollar cost averaging DCA, while sound, has returns artificially inflated by the carry regime's stability. The investor must now recalibrate their expectations for decaying growth and higher crash risk. The day trading psychology in the 2020s is simply a faster, riskier form of the carry trade. where pursuit of small, consistent daily gains is mathematically guaranteed to fail violently when volatility spikes, maximizing exposure to the liquidity trap of the crash. The prevalence of financial TikTok and YouTube gurus promoting steady income strategies using option gambling, selling volatility, is a democratization of the carry trap, generating small, consistent fees to carry. In exchange for exposing their followers to the unhedged, catastrophic tail risk. The intelligent investor must consciously structure their portfolio to be anti-carry, long volatility, to survive the inevitable deleveraging. The final insight from the rise of carry is that structural stability is an illusion that must be actively traded against. The book provides the ultimate framework for recognizing and surviving the carry crash, the inevitable, violent consequence of pervasive leverage addiction and volatility suppression. The investor's primary goal in this regime must shift from chasing the market's return to ensuring capital survival during the systemic crisis. The 10 timeless principles derived from the book are the anti-carry manifesto. The ultimate rule is to beware the smooth return, treating any investment that delivers small, consistent profits with leverage as a structural carry trade that bears negative skewness risk. The smoothness of the return is the greatest indicator of hidden fragility. The investor must then hedge the tail risk, consciously allocating capital to be long volatility, e.g., long-dated protective options or cash, as essential countertrade to the global short volatility regime. This liquidity is crucial because liquidity is anti-carry. Cash generates no losses during the crash and provides the necessary liquidity to seize deep opportunity when the leveraged market is forced to liquidate. The intelligent investor must analyze the credit spread, monitoring credit spreads as a signature of peak complacency and inadequate risk premium, signaling the nearing of the carry crash. It is essential to examine the corporate balance sheet for reliance on cheap debt for share buybacks, recognizing this price support is artificial and highly vulnerable to rising interest rates. The investor must decouple from synchronization, holding assets that are negatively correlated with the carry unwind, recognizing that the next crisis will be global and indiscriminate. The principle of identify funding currencies warns that monetary policy in low-rate regions provides the most dangerous trigger for a systemic carry crash. The investor must reject inadequate compensation, refusing to buy assets where the yield is barely above the risk-free rate, as this signals a market is grossly underpricing the tail risk. The time lag trap demands patience and emotional discipline to remain defensive when the market is euphoric, trusting that the statistical inevitability of the crash will eventually create a profound opportunity. Ultimately, the investor must structure for survival, focusing on out-surviving the market during the inevitable crash, which is the only way to capitalize on the massive mispricing created by the deleveraging event. These principles demand long-term thinking, profound skepticism, and emotional discipline to reject the psychologically addictive profits of the carry trade, ensuring the intelligent investor survives the destructive end of the cycle. The ideological core of the carry trade is the exploitation of human behavioral weakness and the structural flaw in financial systems. It is inherently short volatility, meaning the trade prospers in periods of predictability and calm, delivering a seemingly guaranteed incremental profit, the carry itself. This return profile, characterized by its slow, steady upward march known as the sawtooth return profile, is psychologically addictive. It rewards a trader 99% of the time, conditioning both the individual investor and the largest hedge fund to believe that the negligible daily losses represent the entirety of the risk, driving a relentless escalation of leverage addiction. The accessibility provided by cheap leverage through technology has democratized this addiction, turning the Robinhood generation into a vast army of micro-carry traders using margin to amplify returns on volatile assets, inadvertently participating in the same systemic short volatility that once reserved for institutional desks. The structural threat intensifies because the massive scale of these leverage carry trades actively suppresses volatility, creating the very illusion of safety it requires to thrive. Post-2008 central bank policies, specifically quantitative easing, QE, and zero interest rates, acted as the ultimate accelerant, providing an endless, cheap funding leg for the global carry trade. This deliberate suppression of the cost of funding and the fear index, VIX, artificially inflated asset prices across the spectrum, from ETF dominance to private equity, disconnecting them from the sluggish reality of decaying growth. The authors argue persuasively that much of the asset inflation seen in phenomena like Tesla hype is not a function of exceptional productivity, but the aggressive capital flow seeking carry in a low-rate, low-volatility world. This systemic fragility means the market is not fundamentally stable. It is merely heavily leveraged, and the collapse, the carry crash, will be a synchronized event driven by the instantaneous withdrawal of leveraged capital, proving the author's thesis that stock market volatility actively causes recessions rather than just reflecting them. This framework is the essential lens for understanding the systemic vulnerability of the global financial order. The conceptual integrity of the rise of carry demands a rigorous understanding of its statistical deception. The authors posit that the trade is a mathematical exploitation of the market's failure to accurately price tail risk. The core statistical reality is the negative skewness and excess kurtosis of the carry return profile. Negative skewness signifies that the rare, catastrophic loss is vastly larger than the frequent, incremental gains. This is a financial definition of bearing uncompensated tail risk. Excess kurtosis means these extreme, destructive events occur far more frequently than predicted by standard statistical models. This is the structural reason the strategy remains profitable. It harvests a premium for bearing risk that statistical models perpetually underestimate. The most profound failure lies in the Sharpe ratio, the ubiquitous measure of risk-adjusted return. The authors dedicate a conceptual argument to the Sharpe ratio's inadequacy for carry trades. Because the Sharpe ratio relies on standard deviation volatility as its measure of risk, and because carry trades actively suppress volatility during their long, profitable phases, the Sharpe ratio often presents a carry trade as exceptionally safe, high Sharpe ratio. However, this high reading is a tragic illusion. The Sharpe ratio fails catastrophically to capture the negative skewness, the potential for the single, massive loss that wipes out years of gains. The intelligent investor must recognize that a high Sharpe ratio in a low volatility environment is often the loudest warning siren of an unhedged carry trade. The historical collapse of long-term capital management, LTCM, in 1998, a leveraged carry trade that initially boasted high Sharpe ratios, serves as a canonical example of the statistical deception. The authors delve further into the structural implications of volatility suppression. This is not a passive phenomenon. It is actively engineered by the continuous selling of crash insurance by agents of carry. This constant supply of stability pushes the VIX, the market's fear index, down, creating a self-reinforcing loop that justifies ever-increasing leverage addiction. The resulting market calm is a leverage facade that masks the systemic buildup of unhedged risk. The crucial consequence is a distortion of liquidity. Carry traders provide liquidity during calm periods, but their leverage positions ensure their simultaneous withdrawal liquidity during a volatility spike, transforming a correction into a severe, self-feeding liquidity crisis. The FIRE movement investor who sees a low volatility stock or ETF as safe is unwittingly relying on this manufactured calm, exposing their capital to the catastrophic speed of inevitable deleveraging. The currency carry trade provides the most elegant and historically potent illustration of the carry mechanism's macroeconomic destructiveness. Lee, and Cold Iron use this market to demonstrate how the search for yield, when leveraged, becomes a force capable of dictating global capital flows and triggering sovereign crises. The mechanics are simple: borrowing the funding currency, low rate, and buying the investment currency, high rate. But the macro consequences are systemic. The authors emphasize that the risk is not in the interest differential, but in the exchange rate volatility that can instantly reverse years of profit. The historical case study of the 1997 Asian financial crisis is a definitive proof of the currency carry crash thesis. Prior to 1997, massive capital flows, driven by the leverage pursuit of high carry returns, flooded countries like Thailand, Indonesia, and South Korea, artificially inflating local asset markets and leading to rapid, credit-fueled economic growth. This boom was a function of the carry regime's liquidity dividend. When exchange rate volatility finally spiked due to concerns over fixed currency pegs and debt, the leveraged carry trades unwound simultaneously. Foreign capital rushed out, causing massive, cascading currency devaluations, sovereign debt crises, and profound economic contraction. The crisis was not a slow economic decline. It was a rapid, financially engineered carry crash caused by the sudden, synchronized withdrawal of leveraged financial capital. The authors use this history to dissect the global monetary policy trap. Central banks in low-rate countries like Japan are perpetually trapped as the world's funding source, unable to raise rates significantly without risking a global carry crash that would destabilize their own currency and export markets. This structural bias towards low global interest rates ensures the perpetuation of the carry trade and the ongoing feasibility of leverage addiction. The intelligent investor must understand that their stability is rooted in this precarious global monetary structure. Furthermore, the authors explore the contemporary manifestation of this trade in the retail sphere. The Robinhood generation's use of margin to buy high-return, volatile assets, like certain crypto hype cycles, is a personalized, leveraged carry trade, with cash as the funding leg and the volatile asset as the investment leg. They are implicitly betting that the volatility will not exceed their margin capacity, a short volatility bet identical in profile to the macro currency trade. The aggregate effect of these unhedged micro-carry trades contributes to the overall market structural fragility, ensuring that the next macro carry crash will be amplified by the synchronized failure of millions of retail positions. The pervasive influence of financial TikTok and YouTube gurus promoting these high-yield, leverage strategies further accelerates the democratization of the statistical tail risk. The structural link between carry, leverage, and credit is the mechanism that translates the statistical profit into systemic fragility. Lee, and Coldiron argue that the universal, leveraged pursuit of carry is the dominant force behind credit expansion and the subsequent dangerous compression of all risk premiums. The mandatory use of leverage amplifies the small yield differentials, but simultaneously transforms a minor price movement into a potential catastrophic loss, making leverage addiction a systemic financial necessity. The authors provide a deeper analysis of the compression of credit spreads as the quintessential fingerprint of the carry regime. As leverage capital floods the debt markets, seeking yield, the difference in return between safe government debt and risky corporate debt narrows. This compression signals market complacency and is a profound measure of the system's structural risk. Investors are receiving historically low compensation for bearing high levels of credit risk. The low cost of capital fuels the corporate carry trade. Companies borrow cheaply to fund non-productive activities like share buybacks, masking underlying decaying growth and artificially inflating stock prices, which are heavily represented in ETF dominance. The concept of the reverse carry trade is crucial for understanding systemic losses in sophisticated hedging. A defensive position, e.g., buying insurance or holding protected puts, is often a negative carry trade. It costs money to hold. Sophisticated agents, under pressure to maintain high returns, finances negative carry by putting on an offsetting, high-leverage positive carry trade elsewhere in portfolio. The tragedy is rooted in correlation. During the carry crash, all correlations rushed toward one. The safe positive carry trade collapses simultaneously with the underlying market volatility spike, wiping out the initial hedge and leading to massive, synchronized losses. This illustrates the insidious reach of the carry regime, where even attempts at prudence are structurally compromised by the necessity of generating carry, proving that complex option gambling can be fatally flawed by the carry regime's physics. The authors revisit the LTCM crisis in 1998, framing it as the ultimate systemic failure of the leveraged credit carry trade. LTCM's collapse was not a failure of their mathematical models in normal times, but failure of their models to account for the extreme, non-normal tail risk and the subsequent market illiquidity that their own leveraged unwinding exacerbated. The sheer scale of the leverage loss necessitated a central bank intervention, proving that the carry regime creates liabilities that are too big to fail. The intelligent investor must realize that the structural dependence on bailout ensures the cycle repeats, as the risk of catastrophic loss is transferred from the financial agent to the public. The profitability of the carry trade is the great paradox of modern finance, and Lee, and Coldiron dedicate a rigorous conceptual analysis to explaining this statistical anomaly. The profit is a long-term compensation for bearing the specific risk profile characterized by negative skewness and excess kurtosis, a profile that standard risk metrics fail to capture. The authors use this failure to expose the fundamental instability of the system. The core failure is the ubiquity of the Sharpe ratio. This ratio, which measures return per unit volatility, systematically overstates the safety of carry trades because they actively suppress volatility during their profitable periods. A strategy that generates small, consistent profits and rarely moves low volatility achieves a high Sharpe ratio, attracting massive inflows of capital. However, the ratio is blind to the tail risk, the large, infrequent loss. The authors demonstrate that the carry trade is a structural failure of modern portfolio theory, MPT, which often assumes returns follow a normal, bell curve distribution. The reality of the carry regime is that extreme events occur far more frequently than the bell curve predicts excess kurtosis, ensuring the devastation of the carry crash is systematically underestimated. The dimensions of carry, termed structure, credit, volatility, and equity, are all united by this statistical failure. The profitability in each dimension is the premium harvested for the structural mispricing of tail risk. The authors emphasize that the current environment is defined by inadequate compensation for massive, systemic risk because a continuous flow of capital, driven by leverage addiction, has compressed the risk premiums to historic lows. The market is being paid less than ever take on the same, or even greater, level of volatility risk. The structural implication for liquidity provision is critical here. Carry traders provide stability and insurance, but their leveraged, short volatility positions ensure that when the carry crash occurs, they are forced to liquidate instantly and simultaneously. This creates a vicious circle where volatility spikes, triggering forced selling, which in turn causes liquidity to vanish, amplifying the price movement and ensuring the crash is deep and synchronized. The authors view this as a fundamental instability of the system. The profit mechanism carry is inextricably linked to the mechanism of destruction, synchronized leveraging. The intelligent investor must reject the comfort of a high Sharpe ratio in this regime. They must apply the principle of risk by accounting for the possibility of 4 or 5 standard deviation loss, a systemic carry crash that is far more likely than MPT suggests. The only rational defense is to consciously structure the portfolio to be anti-carry, to be long volatility and short the persistent, yet destructive pursuit of yield. The sociological dissection of the agents of carry reveals the incentive structures that guarantee the perpetuation of the carry regime. Lee, and Cold Iron argue that the problem is not isolated to a few speculators, but is institutionalized and democratized, making systemic risk pervasive. Hedge funds and proprietary desks are the system's most concentrated and dangerous agents. The authors dedicate a conceptual argument to the moral hazard created by their asymmetric compensation structure. Traders are rewarded handsomely for small, persistent profits generated by carry, but the catastrophic losses are socialized, borne by the institution, the subsequent investors, or the taxpayer. This flawed structure incentivizes excessive leverage addiction and the systematic underestimation of tail risk, as the trader maximizes personal gain during the long expansion, knowing the carry crash will occur on someone else's watch. The analysis of institutional investors, pension funds, endowments is crucial as they become involuntary agents of carry due to high, non-negotiable return mandates, e.g., 7 to 8% targets for the FIRE movement. In a low-rate, low-volatility world, these targets are unattainable without engaging in implicit carry trades, investing in a liquid, high-yield private assets, or selling complex options to boost current income. The structural pressure forces conservative capital to take on a statistically dangerous negative skewness risk, ensuring that the inevitable carry crash will profoundly impact retirement systems and contribute to social fragility. The democratization of the carry trade through the individual retail trader is the modern acceleration point. The authors highlight that the combination of zero-commission trading and easy access to margin, enabled by cheap leverage through technology, has turned the Robinhood generation into a vast, unhedged army of micro-carry traders. Strategies promoted by financial TikTok and YouTube gurus, such as covered calls or dividend stock leverage, are classic carry trades, exploiting the addictive nature of small, consistent profits. The aggregate size of these unhedged positions contributes to volatility suppression, while exposing millions to catastrophic, synchronized loss of the carry crash. The authors conclude that regulatory attempts post-2008 failed to address the core problem, the cost of funding and the asymmetry of incentives. The banking system remains a massive carry machine, and incentives for proprietary trading remain. The result is a system where the pursuit of carry, fueled by cheap funding, is a rational choice for every agent, despite the collective, catastrophic consequence of their synchronized behavior. The intelligent investor must recognize that the system is structurally rigged against long-term stability and prioritize capital preservation over the pursuit of the market's artificially inflated returns. The carry regime is the author's ultimate conceptual framework, defining the new financial order as a system locked into a perpetual cycle of financial boom and violent crisis. This chapter provides a synthesis, arguing that the system is an unstable equilibrium, stable on the surface, but structurally prone to massive leverage collapse. The fundamental nature is the structural dependence on volatility suppression and the systematic compression of all risk premiums. The long, stable expansion is merely the period where carry trades generate profits, fueling leverage addiction and asset price detachment from the reality of decaying growth. The authors argue that this regime redirects capital from productive long-term investment, which is inherently volatile, towards short-term financial engineering, which is structurally smooth, thus slowing real economic growth while inflating asset prices. The carry crash is the necessary violent correction. It is triggered by a volatility spike that forces the synchronized, leveraged unwinding of carry trades across all dimensions, currency, credit, and equity. The author stressed the concept of correlation spike. During the crash, assets that were previously uncorrelated suddenly move in the same direction, amplifying losses and guaranteeing the systemic nature of the crisis. This event is a true trigger for the recession, proving that financial market volatility actively causes economic contraction, which is the core structural flaw of the regime. The authors strongly connect the regime to global wealth inequality. The process of asset inflation, fueled by cheap carry funding, systematically benefits those who own assets and can access leverage, exacerbating the disparity between capital owners and labor income. This financialization of the economy at the expense of productive growth is a profound sociological driver of inequality, contributing to political and social tensions that define the era of decaying growth and recurring crisis. The final, chilling conclusion is the regime's persistence. The fundamental profitability of the carry trade, selling insurance against rare events, ensures that immediately following a crash, fresh capital will be lured back into trade, guaranteed by central bank policies that suppress rates and volatility to prevent economic collapse. This creates the unstable equilibrium, a perpetual cycle that is statistically guaranteed to repeat. The only rational response of the intelligent investor is to recognize this reality and structure their portfolio to be anti-carry, to consciously be long volatility and short the systemic pursuit of carry. The contemporary financial landscape serves as the ultimate laboratory for the carry regime, demonstrating how technology and policy have amplified its scale and fragility. The authors would emphasize that the post-2020 environment is one of extreme risk mispricing. AI-driven hedge funds and algorithmic trading are viewed as the most efficient agents of carry, specializing in the high-speed harvesting of volatility carry. The authors warn that these systems' reliance on synchronized models and high leverage ensures that the next carry crash will be a flash crash, a massive, instantaneous deleveraging that is far faster and more destructive than previous crises. The individual's time window for reaction will be negligible. The intelligent investor must use the principle of risk to assume this extreme speed. The corporate carry trade remains the structural vulnerability in the equity market. The pressure from index funds dominating global wealth compels corporate management to continue borrowing cheaply to fund share buybacks. The authors stress that the stability of the entire passive investing movement is now structurally reliant on the continuation of low borrowing costs, meaning passive investors are implicitly the largest funders of the carry regime and exposed to the ultimate synchronized crash. The analysis of crypto hype cycles and NFT madness is crucial here. The low cost of funding and FOMO culture drive leverage capital into these assets, creating speculative bubbles that are ultimately carry trades betting on a narrative's continuation. The volatility is a measure of the extreme risk being taken. The intelligent investor must apply the principle of value and recognize that these assets lack the fundamental cash flow necessary to withstand a major global liquidity withdrawal. The authors would offer a stark final comparison. The day trading psychology in the 2020s, fueled by cheap leverage through technology and financial TikTok and YouTube gurus, is a mass adoption of the short volatility trade. It works on calm days, but is mathematically guaranteed to fail violently when volatility spikes, maximizing exposure to the liquidity trap of the crash. The only rational counter is a defensive portfolio consciously structured to be long volatility, prioritizing survival over pursuit of the market's artificially inflated, carry-fueled returns. The ultimate insight from the rise of carry is that structural stability is a lucrative illusion that must be actively traded against. The book provides a definitive framework for recognizing and surviving the carry crash, the inevitable, violent consequence of pervasive leverage addiction and volatility suppression. The investor's primary goal in this regime must shift from chasing the market's return to ensuring capital survival during the systemic crisis. The 10 timeless principles derived from the book are the Anti-Carry Manifesto. The ultimate rule is to beware the smooth return, treating any investment that delivers small, consistent profits with leverage as a structural carry trade that bears negative skewness risk. The smoothness of the return is the greatest indicator of hidden fragility. The investor must hedge the tail risk, consciously allocating capital to be long volatility, e.g., long-dated protective options or cash, as essential countertrade to the global short volatility regime. This liquidity is crucial because liquidity is anti-carry. Cash generates no losses during the crash and provides the necessary liquidity to seize deep opportunity when the leveraged market is forced to liquidate. The intelligent investor must analyze the credit spread, monitoring credit spreads as a signature of peak complacency and inadequate risk premium, signaling the nearing of the carry crash. It is essential to examine the corporate balance sheet for reliance on cheap debt for share buybacks, recognizing this price support is artificial and highly vulnerable to rising interest rates. The investor must decouple from synchronization, holding assets that are negatively correlated with the carry unwind, recognizing that the next crisis will be global and indiscriminate. The principle of identify funding currencies warns that monetary policy in low-rate regions provides the most dangerous trigger for a systemic carry crash. The investor must reject inadequate compensation, refusing to buy assets where the yield is barely above the risk-free rate, as this signals a market is grossly underpricing the tail risk. The time lag trap demands patience and emotional discipline to remain defensive when the market is euphoric, trusting that the statistical inevitability of the crash will eventually create a profound opportunity. Ultimately, the investor must structure for survival, focusing on outsurviving the market during the inevitable crash, which is the only way to capitalize on the massive mispricing created by the deleveraging event. These principles demand long-term thinking, profound skepticism, and emotional discipline to reject the psychologically addictive profits of the carry trade, ensuring the intelligent investor survives the destructive end of the cycle. The exhaustive analysis of the rise of carry leads to an inescapable conclusion. The tranquility of the modern financial market is not evidence of its health, but a symptom of its most profound, self-inflicted disease. The carry trade, in its myriad forms, has grown into a global, systemic force that suppresses volatility and creates an illusion of stability, trapping the global economy in a structural pattern of decaying growth and recurring crisis. The authors Tim Lee, Jamie Lee, and Kevin Coldiron have provided the intellectual weaponry necessary to dissect this reality, revealing that the true danger lies in the leveraged synchronization of the system, a vulnerability accelerated by the technological and monetary policies of the 21st century. The structural integrity of this carry regime is rooted in the simple yet fatal exchange of small, frequent profits for rare, catastrophic losses. This negative skewness defines the system's statistical pathology, a pathology that is aggressively exploited by agents of carry, from AI-driven hedge funds utilizing high-speed algorithms to the individual Robinhood generation, engaging in micro-carry through margin, all fueled by cheap leverage through technology. The persistent profitability of the carry trade is the insurance premium collected for bearing the tail risk, a statistically sound business that only collapses when the market fundamentally misprices the probability of the catastrophe. The authors emphasize that the market is currently in a state of inadequate compensation for massive, systemic risk, primarily due to central bank volatility suppression policies that have artificially lowered the funding leg cost to near zero, thereby increasing the leverage and scale of the trade to unsustainable levels. This environment fuels the asset inflation seen in Tesla hype and crypto hype cycles, disconnecting valuations from the stagnant reality of decaying growth. The most insidious sociological consequence of the carry regime is the redistribution of wealth from labor to capital. The continuous flow of cheap, leveraged funding drives up the prices of assets, stocks, bonds, real estate, benefiting those who already own capital and can access leverage. This process exacerbates global wealth inequality, turning the financial system into a mechanism that structurally favors the agents of carry at the expense of the working class, whose labor income is not appreciating at the same rate. The pursuit of carry is not just an economic force. It is a sociological driver of inequality and political tension, which ultimately contributes to the very instability that triggers the carry crash. The author's analysis of the business cycle as a carry cycle is a foundational macroeconomic insight. The long, calm expansion is merely the leverage buildup period where credit spreads are compressed and leverage addiction thrives. The carry crash is the inevitable violent resolution, triggered by a volatility spike that forces the synchronized leverage unwinding across all asset classes, currency, credit, and equity. This unwinding destroys capital and causes a massive, instantaneous liquidity vacuum, proving that financial market volatility actively causes economic contraction rather than merely following it. The historical collapse of LTCM in 1998 and the 1997 Asian financial crisis stand as irrefutable proof that the system's fragility is rooted in the leveraged synchronization of the financial agents. The core intellectual challenge the book poses to the intelligent investor is the failure of conventional risk metrics. The Sharpe ratio, the ubiquitous measure of risk-adjusted return, is systematically misleading for carry trades because it measures volatility, standard deviation, which the carry trade actively suppresses, while failing to capture the catastrophic negative skewness, the potential for the single large loss. A high Sharpe ratio in a low volatility environment is, therefore, the highest warning siren of an unhedged carry trade. The only rational defense is to reject the statistical comfort of conventional models and structure portfolio to be anti-carry, to consciously be long volatility and short the persistent, yet destructive pursuit of yield. This requires profound emotional discipline to remain defensive when the market is euphoric and trusting the statistical inevitability of the crash. The sociological pathology of the carry trade is further revealed through the actions of the individual retail trader. The democratization of leverage through zero-commission trading has turned the Robinhood generation into a vast, unhedged army of micro-carry traders. Strategies promoted by financial TikTok and YouTube gurus, such as selling covered calls or borrowing to buy high-dividend stocks, are classic carry trades, exploiting the addictive nature of small, consistent profits while exposing millions to the catastrophic tail risk of a synchronized collapse. The aggregate size of these unhedged micro-carry positions contributes to the overall market structural fragility, ensuring that the next macro-carry crash will be amplified by the synchronized failure of millions of retail accounts. The only rational counter is a defensive portfolio consciously structured to be long volatility, prioritizing survival over pursuit of the market's artificially inflated carry-fueled returns. The investor must embrace the principle of risk by accounting for the possibility of 4 or 5 standard deviation loss, a systemic carry crash that is far more likely than modern portfolio theory suggests. The ultimate framework for survival demands the intelligent investor embrace the anti-carry manifesto. This means hedge the tail risk by allocating capital to strategies that thrive during a volatility spike, such as long-dated protective options or maintaining substantial cash reserves, which are the ultimate anti-carry asset, and provide the necessary liquidity to seize deep opportunity. When the leveraged market is forced to liquidate, it requires the discipline to analyze the credit spread, monitoring the compression of risk premiums as a signature of peak complacency, and the courage to decouple from synchronization, holding assets that are negatively correlated with the carry unwind, recognizing that the next crisis will be global and indiscriminate. The timeless lesson to rise of carry is that the market will always offer the temporary, leverage reward for bearing uncompensated risk. But the only sustainable path to wealth is a rejection of that temptation and the prioritization of structural resilience against the inevitable, cyclical violence of the carry regime.